These are shots taken more than 2 hours ago at the Constantine Palace of the opening of G8 Summit in St. Petersburg. We will keep you updated on the latest development of the world leaders meeting. Hello and welcome to the special coverage on CCTV News. I'm Zhou Yue in Beijing.
And I'm Wang Mengmang.
Well, the G20 Summit has opened in Russia in St. Petersburg. Leaders from 34 countries and organizations are now in St. Petersburg for the two-day summit.
And this is also the first multilateral summit for Chinese President Xi Jinping, who took office last March. We have a packed show for you in the next 60 minutes.
And for more on the event, we'll be joined by Professor Zhu Ning, Deputy Director from the Shanghai Advanced Institute of Finance of Shanghai Jiaotong University, and economist from Bonn. Well, he will be Joseph Janning, a fellow, the German Council of Foreign Relations from Germany, and also our reporters.
And our reporter Guanxin is standing by in St. Petersburg. She's there to cover this two-day summit. All right, so Guanxin, now let's begin with you. Guanxin, we understand that this is the first multilateral summit for Chinese President Xi Jinping, and he'll be really busy meeting with heads of state from, the 30 countries and organizations. So, what can you tell us about his activity today?
G20 leaders have descended upon St. Petersburg today, and Russia held a welcoming ceremony this afternoon. And first, the working meeting of the G20 Summit have started, and it will last a few hours. Russian President Vladimir Putin outlined the major goals of this summit, which include economic growth, job creation, and also continued reform of the global financial architecture. And on Syria issue, which is overshadowing the summit, he said it is not on the official agenda, so they will not be discussing it at the working meeting, but they could discuss it at during the dinner in about an hour. And ahead of the official meeting, there has been a lot of one-on-ones between heads of state, which carries even more significance to reflect the current sentiment in the political arena. For example, we know that the first bilateral meeting by Russian President Vladimir Putin was with Chinese President Xi Jinping.
A flurry of meetings ahead of the summit. On Thursday, President Xi Jinping held talks with his Russian counterpart Vladimir Putin. The two leaders discussed strategic coordination on international and regional affairs, the Syria crisis, and efforts to combat flooding in the northeast of China and Russia's Far East. They also discussed cooperation on large-scale projects. This is the second time they met after Xi Jinping took office in March this year. In a meeting with his Argentine counterpart Cristina Fernandez, Xi Jinping called for joint efforts to safeguard the interests of emerging economies and developing countries. The two sides vowed to expand cooperation on energy, mining, hydropower, infrastructure, and finance. Xi Jinping also met with Brazilian President Dilma Rousseff. Xi Jinping said China and Brazil should strengthen coordination to oppose trade protectionism and safeguard common interests of emerging markets. Xi Jinping also called for more cooperation in energy, mining, agriculture, and infrastructure. Rousseff said emerging markets need to step up joint efforts to urge certain countries to adopt responsible economic policies and promote the reform of the international financial system. As well as meeting world leaders, the Chinese president also met the Director General of the World Trade Organization, Roberto Azevedo. Xi Jinping urged the WTO to play a bigger role in safeguarding and consolidating a multilateral trade mechanism. China hopes the WTO will push through the stalemate in the Doha round of global trade talks, oppose trade protectionism, and boost liberalization of global trade. Azevedo said the WTO is willing to strengthen cooperation with China and promote the Bali meeting later this year. On Wednesday, Xi Jinping met with his Mexican counterpart Enrique Peña Nieto. Xi Jinping wants to speed up negotiations to set up a China-Mexico investment fund and he says China is willing to work with Mexico to establish a China-Latin America Cooperation Forum. Peña Nieto says Mexico hopes to expand two-way trade with China and will take steps to improve market access for Chinese goods. The two leaders agreed to coordinate action at the summit. Their goals are to safeguard the momentum of the world economic recovery and increase the voice and influence of emerging economies in global economic governance.
Analysts say Chinese President Xi Jinping is going to rally emerging economies at this year's G20 Summit, and it is the first year for that the GDP of developing countries exceeded that of developed countries. So G20 Summit in Russia comes at a crucial time for emerging economies to assume a bigger role in world economic affairs. Mama.
Well, Guan, the emerging economies have been the major driving force for global growth over the past few years, but now they're experiencing some turbulence, and we are starting to see signs of a downward risks showing. So. And President Xi Jinping is expected to meet with other leaders from the Brics nations. What are they going to talk about?
Russian President Vladimir Putin hosted a mini summit with Brics leaders ahead of the official G20 meeting, and it has been very pragmatic. They agree on the establishment of the 100 billion currency reserve arrangement, or CRA, and they also agree on the contributions. China is committed to the bulk of the contributions of 41 billion US dollars, Brazil, India, and Russia 18 billion US dollars each, and South Africa 5 billion US dollars. And the mechanism is aimed at to ease the short-term liquidity pressure of emerging markets and safeguard financial stability of emerging economies. We know that emerging economies are experiencing a sell-off of their bonds, currencies, and stocks recently due to the U.S. tapering out. So the mechanism will play a big role in stabilizing these markets. And analysts say it's going to be a supplement to the current global financial architecture, because although there has been calling for reform of the current global financial institutions, such as to increase the voice of developing countries and their representation in IMF, the progress has not been very smoothly. So the new mechanism by emerging economies by themselves will be a supplement to the current global financial architecture. Mama.
Well, thank you so much, Guan, and we'll talk to you again later on in this program.
Yes, indeed. There was a lot of cover at the G20 Summit this time in St. Petersburg. Actually, the Group 20 Summit has just opened in St. Petersburg, bringing together leaders from 34 countries and organizations for a two-day summit in Russia's second largest city. And leaders hold their first meeting as the summit gets underway at Constantine Palace. G20 countries account for 90% of the world's GDP, with a focus on economic growth and jobs. World leaders will talk about topics such as sustainable and balanced development, reform of the international monetary and financial system, and quantitative easing policies being implemented by developed countries. The summit comes as the global economy begins to show signs of weakness. Developed countries are now facing severe challenges such as debt crisis in the European countries. And concerns are now focusing on emerging markets that have helped to drive the global economy for the past several years, and today growth has slowed down considerably as foreign investors pull their money out and growing costs rise.
Well, let's also take a look at the Brics nations. Leaders from the emerging Brics countries have held sideline meetings at the G20 Summit. And the 5 large emerging economies include Brazil, Russia, India, China, and South Africa. The Brics countries have agreed to contribute 100 billion US dollars to help countries facing currency shocks. During this meeting, China committed $41 billion, Brazil, India, and Russia 18 billion each, and South Africa 5 billion. Leaders from the 5 countries have also agreed on the structure of a proposed development bank with 50 billion US dollars in capital. And talks on developing a bank that will provide funds for infrastructure projects have seen slow progress, as disagreements over funding and management of the institution remain unsettled.
And now for more insights about the G20 Summit in St. Petersburg, we're now joined in the studio by Professor Zhu Ning from Shanghai Jiaotong University, and also Macroeconomic economist and Vice President of the National Economist Club in Washington, D.C., and Joseph Jennings, Fellow of German Council of Foreign Relations in Bonn. Let me start with Mr. Zhu. So compared with 5 years ago, how would you evaluate the function of the G20 institution?
Well, I think G20 was far more effective or far more united 5 years ago when the whole world is facing with an unprecedented financial crisis over the entire world. And 5 years later, I think as the financial crisis gradually grew out of people's attention, I think people are I think more open-minded to talk about other issues, but at the same time, I think there's less a sense of urgency to get things done right away.
Maricruz, what do you think are the most pressing issues when the G20 leaders are meeting in St. Petersburg?
Well, the first thing that they have to deal with is the debt that developed countries are carrying, because it's not only affecting these developed countries, but also developing countries. Look at the United States. Their debt is like 70% of their GDP, and total debt is equal to their GDP. It's not sustainable, and it has literally decreased the size of the U.S. economy. We are seeing high unemployment rates, even if the formal unemployment rate is only 7.4%. Everybody knows that if you take into account the people that are not looking for a job, etc., or people that would like to work full-time and are only working part-time, past the 13%, that has effects in the rest of the economy. So the United States started the quantitative easing 1, 2, and now we are in quantitative easing 3. And it was going very well. That, along with the increasing taxes to people that are making more than $400K per year, plus the sequestration, actually improved the economy of the United States in the first half of 2013. But unfortunately, the president of the Fed, Ben Bernanke, in the meeting that he had in Congress on May 22nd, he hinted that the Fed was thinking to taper these $85 billion that the Fed is buying every month through the quantitative easing, in other words, putting money into the economy.
So the tapering
that
of the stimulus
created
pressures
panic.
Will be felt by the rest of the world, especially the emerging economies. And Joseph, do you think those emerging economies can take those tapering of stimulus in the Western world easily?
No, not easily. They certainly have a role due to their economic potential and due to the fact that they can still grow, and they still have the potential to grow significantly. But on the other hand, my U.S. colleague is right. Much of the agenda is to be fulfilled at home. It's the debt situation, it's the economic reconstruction, it's a major governance reform that we see in many parts of Europe. And if you look at a country like Germany, which has almost full employment, we've just seen a new report that the unused labor force in the country is still around 6 million people. So that's quite a lot, and there's quite some potential for Europe and the West at large to clean up its house and bring it in order.
So there is a divergence of emerging economies and those developed economies. Can they agree on something that can coordinate their macroeconomic policy, Mr. Zhu?
I think conceptually, yes, they should, and they would have to. I mean, to have a more balanced economy and a global financial and a monetary system. But I think there are probably two impediments to the both sides to reach an agreement. One is, I think, long term. I think it's just when we look at, I think that the G20 Summit meeting, when we look at the IMF, the World Bank, international organizations, I mean, they are still primarily being dominated by developing economies. So, I mean, that sort of leads to the consequence of the voices of emerging markets not being heard as much as they should be. And I think there's a more pragmatic issue, that is, every country is thinking in their own interest. And then I think that the U.S. Federal Reserve has reiterated its opinion that it is always trying to do the best for its own citizens, and it is reporting to its own Congress. So there's always, when the Federal Reserve was rolling out the quantitative easing, there has been a lot of concerns from the emerging market side. And I think now the tapering off of the QE is again calling off a lot of attention from the emerging markets. So fundamentally, there is some different pursuits for different economies.
Yes, indeed. The Federal Reserve may have reasons why to taper its stimulus measures, and that's the reason that the American economy has been picking up, or at least some people think that it is. For more on that, let's turn to my colleague, Mama.
Indeed, so it does seem that the U.S. economy is slowly getting back on track. Now, revised U.S. growth figures for the second quarter of the year show an improving picture for the world's biggest economy. Well, but that's also likely to prompt the U.S. Federal Reserve to unwind its stimulus actions more quickly. So, what does this mean for the capacity of the U.S. economy to grow? Here's a report from our correspondent Danny Rinches in Washington.
Since the financial crisis began, the U.S. Federal Reserve has boosted the supply of money so that borrowing and investment costs are artificially suppressed. But the banks have resisted passing on the benefits to all, including Alexandria Coliseum. This small family-run business wanted to put up a large sports and leisure facility, but they've been forced to limit their ambitions to renting out large inflatables for children's parties and public events.
Without the faith and confidence of friends and family, we wouldn't have gotten off the ground.
The funding by friends and family of this one-year-old enterprise in the Washington, D.C. suburbs is nonetheless built on greater optimism in the capacity of the U.S. economy, despite recent dramatic reductions in government spending.
We're sort of in a niche business, and being in the general Washington area, even with the sequester, we haven't seen a lot of cuts to employment locally. As long as the employment picture continues to improve in this area and across the United States, we see no problems in our business continuing to grow.
But such improvements will quicken the pace of the Federal Reserve's actions to unwind its artificial stimulus.
Consternation in financial markets is translating into somewhat higher interest rates, long-term interest rates principally, and that's a little bit of a drag on growth. But if you ask me for my opinion, when stimulus ends, it's going to be a good thing. Let the economy stand on its own feet.
So though the U.S. economy, like this business, is starting to bounce, it still has a long way to go before it reaches full capacity. Daniel Wrenches, CCTV, Washington.
Wow, that's a metaphor that Daniel has been making to the American economy. So, Maricruz, do you agree that the American economy is still in shaky ground? What is the thinking behind the Federal Reserve's decision to tapering the monetary policy?
I will not be surprised if the Fed changes its course at the end of the year at the December meeting and announces a Q4. And I will tell you why. The reason is that they thought that the U.S. economy was ready for starting reducing the purchases of bonds. They were even talking about reducing from 85 to 65 and doing it slowly, more and more. But the minute that the Fed announced that in May, immediately we saw the results in June. For example, the mortgage interest rates went 1 point from 3.5 average to 4.5. That means $200 more per month for a family that purchases a home of $240,000. That is not a small thing. We immediately saw that the new home building fell by about 8%. In July, it fell by 13%, the sales of new homes. So the Fed probably acted too quickly in May, and I don't think it was a good idea to scare the global markets in this way. And I will not be surprised, as I said, if they start with Q4. And even some economists, they think that if the economy starts again showing signs of higher interest rates, or people that the unemployment will not change significantly. Also, the GDP grew by 2.5% in the second quarter, but now they are saying that it may go down to 1.5. In that case, the Fed will not only continue with a Q4, but raise it to about $100 billion per month.
So, Mr. Zhu, are you optimistic about American economy? Is it on the way to recover?
I think I'm cautiously optimistic. I think there are probably a few signs which is saying the U.S. economy is on its track to recovery. One is the housing market. I think as my U.S. colleague has mentioned, I think the housing market is showing some signs, not only domestically, but also international investors that are pouring in to invest in the U.S. market. The second is the financial sector. I think most of the financial institutions have already completed their round of the leveraging and the consolidation. And then we have already witnessed the significant improvement in the job market. So I think those three pictures are pointing an encouraging picture. Of course, there are uncertainties.
Maricruz, do you agree? Because what brought the American economy down 5 years ago is because of the financial meltdown. Do you think the financial regulation is sound enough to make that to make us all sure that it won't happen again?
Well, any kind of monetary policy, conventional or not, which is the QE3, which is quite unconventional, is not going to lift the U.S. Economy in a sustainable manner. As long as the U.S. has had a huge debt, it's not going to happen. And the only way to start reducing significantly this debt and the annual deficits is by improving economic growth. And the U.S. has to take serious policies in order to do that. For example, they need three important policies: an energy policy. They need to allow more production, not only exploitation of the fossil fuels, which nobody wants that in the environmental field, but they have to do it. That doesn't mean that they are not going to continue investing in renewable energy, but they need to do that not only for the reason that they will create jobs, but it will also make the United States energy independent, and that's very important, not only for its economy, but also for national security. Then they need a tax reform, and they need an immigration reform, and they need to do that as soon as possible.
All right. Maybe the Americans feel a little bit smug when they look at Europe, because Europe is still in the deep throes of financial problems, debt problems in Europe. For that, let's turn to my colleague, Mama, again.
Although job creation is expected to top the agenda in St. Petersburg, and it's probably one of the biggest concerns for European countries. The Eurozone is suffering record high unemployment, and it could get worse, especially in the weaker economies. But while many people fear for their jobs, business managers are much more optimistic. Confidence among business managers polled by the European Commission rose for a fourth successive month in August. The positive trend was particularly strong in Germany and the Netherlands, but it was also seen in Italy, France, and Spain. While the measure of sentiment across the currency bloc in August, based on business orders, industrial confidence, and other factors such as companies' hiring plans, increased by 2.7 points to 95.2. But while morale improved, unemployment in the Eurozone in July remained at a record high of 12.1%. And there is a huge variation in jobless rates between countries such as Germany, where the job market is robust, and Greece or Spain, where more than 1 in 4 workers has no job.
So where exactly is European economy right now? For that, let's turn to Joseph. Joseph, what is your reading of European economic performance?
Well, we do see signs of a slight recovery. And not just where we would expect it to see in the north of Europe or in the industrial center of Europe, but we also do see some recovery in the south. We do experience that some of the structural reforms that these countries have undertaken under massive pressure because of the conditionalities of financial aid are beginning to work. At the same time, they are in a very critical situation. You know, the high unemployment rate, especially among the young people, in Spain and in Italy, Greece is a slightly different case, is mostly due to an outdated set of labor laws which make it almost impossible for employers to fire people, so they will not hire. And a lot of young people don't have the right skills for a labor market or for an economy that is not booming in the housing sector like the Spanish is now. So there's an enormous effort needed in continuing reform and refocusing also the educational system, but the latter will only show effect over time.
And what do you think are the pressing problems facing Europe? Because it is still under the shadow of the debt problem, and also unemployment rate is still very high.
Yes.
Joseph?
Yes, both factors are there. And neither one of the two is going away very soon. The debt issue is critical. I think it can come under control. I think the way that the ECB, the European Central Bank, and member states are managing it, if not disrupted by external shocks, has a good chance of succeeding, but is a long-term operation. On the labor market end, it is critical that industrial production and high-quality services pick up in Europe again, and that depends on the competitiveness of Europe's various industrial regions. Here, Germany is very strong, and the South still is struggling to get stronger.
Let's take a look at one example of the European economy, well, that's United Kingdom. For that, let's turn to Mama.
Well, so ahead of the G20 Summit's agenda, our reporter Richard Bestig spoke to John Micklethwait, the editor-in-chief of The Economist. He says trade is expected to top the agenda at the summit, and that despite numerous differences, G20 leaders should be able to achieve some kind of agreements.
Of course, the G20 is, at the end of the day, an economic gathering. What is it the Economist believes the 20 leaders should be focusing their attentions on?
I would be wildly excited if anything to do with trade came out of it, but it's highly unlikely because all the main bits are going in the wrong direction at the moment. But you could begin to see stuff about finance, a little bit about stuff about banks. There's room to just keep things moving ahead. And I think the balance of power economically has changed just a bit. A year ago, the emerging world was shooting ahead. Everyone seemed hunky-dory there. By contrast now, America is beginning to come back on the back of shale gas, on the back of having flushed out most of its financial problems in the banks. By contrast now, we have worries about Chinese banks. We have worries about the Indian currency. We have worries about a great many things in the emerging markets. So that's balanced up slightly.
There are those who suggest that very little can be achieved between 20 world leaders in just 2 days.
I think it's possible for 20 world leaders to achieve quite a lot if there's a general sense of crisis, particularly economic crisis, to pull them together. But that sort of vision of the G20 as the economic rulers of the world, that has proved to be unsatisfactory when it comes to political problems like Syria. It's not the ideal forum to deal with those things because they're such widely differing starting points. On the world economy, most people just want the world economy to do well. When it comes to issues like Syria or Egypt or Tibet or any of these difficult, thorny issues, then you're going to have different views.
And that's the editor-in-chief of Economist. And coming up on this special program, we will talk about how to reform the international financial institution.
And we'll be also looking at the prospects of emerging markets, especially what the Brics nations can do to stabilize their own economies. Stay with us.
Welcome back to our special coverage on CCTV News, and we will be covering on the G20 Summit in St. Petersburg about breaking down of the data and where the world economy is heading.
Well, the IMF plays a very important role when it comes to monetary policy. The IMF Board of Governors have approved a quota and governance reform package put forward in 2010. The package includes a doubling of IMF quotas under the 14th General Review of Quotas and a shift in quotas to dynamic emerging markets and underrepresented countries. It also includes a proposed amendment to reform the IMF's executive board to make it more representative, where all members elected. While for the quota increases to become effective, two conditions need to be met. First, the proposed amendment to reform the executive board has to be accepted, and this requires acceptance by 3/5 of members who hold 85% of the IMF's total voting power. And second, members having no less than 70% of the total quotas as of November 2010 had to consent to the quota increase under the 14th General Review of Quotas. The IMF aimed to make the 2010 reform package effective by 2012, but the legislature of some IMF members, including the United States, had not yet given the green light.
So that sounds like a very complicated reform for the IMF. But in essence, what is the realistic aim for the reform of International Monetary Fund, and why we need to reform the institution?
I happened to be invited to visit the IMF just a month ago, and I think I got some really first-person experience there. I think, from the top to the bottom, I think that the fund is starting to feel that, well, as the global economy is becoming more and more international, and as the economy is becoming more multilateral, the fund is no longer being updated with where the economy is headed. So I think it is sincerely trying to diversify itself into a more international and more representative organization. So I think that is the ultimate goal. But given where the fund is standing right now, I think there's a long way for the fund, not only in terms of its executive board, but also in terms of its representativeness of the balance between the developed economies and the emerging markets. I think there's a lot that has to be done among the member countries.
So you're saying the institution is not in line with the economic reality in the world?
Not at the moment.
So by how much it needs to improve?
I think considerably. If you look at the representation of the global economy between the developed economy and the emerging markets, and the number of votes or the number of funding coming from developed economies versus the emerging markets, I think the contrast is quite stark.
And Joseph, of course, we know the current Director General of IMF is a French. What is the Europeans' take on the reform of the IMF? Is there any resistance?
Well, in general, the Europeans are in favor of reforming, also reforming the quota system. They are in favor of including the emerging markets more strongly, to increase the stake of emerging markets in managing and taking responsibility for the global economy. But the Europeans also have a dilemma. I think they know that over the midterm they should make room for more members and in a way replace the somewhat old-fashioned representation of the individual European countries with a single membership. At least the Eurozone should be one member. That would make it much easier to get more stakeholders around the table and share voting rights in a more equitable way.
But have the European bankers and decision makers come to the terms that they may have dwindling a say in the international monetary system?
Well, so far, the IMF is based in Washington, and the director always is a European. And that deal, which satisfies many Europeans, won't go on. I think if the Europeans want to maintain their leverage on the institutions, they should not be the ones blocking the reform of the institutions. Rather, they should be the one to be leading the reform, in fact.
But coming to the emerging economies, do they have convergent interests and requirements on the reform of the international financial institution, or do they have different opinions?
Yeah, I think they do. I think that the short answer is yes and no. In general, I think the emerging markets all want to have more bargaining power collectively against the developed economy. but when it breaks down among different emerging markets, there are a lot of different pursuits among different countries. I mean, some prefer to have better control over their reserve system. Some want to have more influence over regional monetary system, whereas some others want to have closer ties to developed economies. So when it brings down to what specific agenda each country is trying to achieve, I think there also have to be a lot of negotiations among the emerging markets themselves.
Where is China's role in this, and what does China want to be looking like in the International Monetary Fund?
I think China is factually playing a leading role in grouping together the emerging market countries to form this collective bargaining body. I think if you look at the recent Brics banks and the Brics reserve system, I think if you look at the voting power and the amount of funding coming from respective countries, China has been playing a leading role. But there's a little bit dilemma in this system. Yeah. On one hand, I mean, China can be spearheading this progress, but on the other, especially with the slowing down of the Indian and the South African economy and Brazilians, it seems that it's not enough for China itself to push forward this reform. I mean, there have to be more countries coming along the bandwagon to form a more collective bargaining process.
The emerging economies have to band together on this most important issue. And for more on the latest development of the G20, let's turn to my colleague Mama.
Well, we have Guanxin in St. Petersburg. Zoya, she's going to bring us the latest from the summit. Well, Guanxin, there have been reports saying that one of the most recent financial concerns is shadow banking. Tell us exactly what shadow banking is and what does it mean for the world economy?
Well, Mama, at the G20 Summit, leaders are expected to agree on the time frame to regulate the so-called shadow banking sector, and it is likely to be the year 2015. So, if realized, it will be the first set of global rules of the shadow banking sector. Well, the scale of the shadow banking is estimated at some $60 trillion, which is roughly the same size of global economy. It includes the credit investment funds, exchange traded funds, and credit hedge funds, and many other forms. The Financial Stability Board will come up with specific requirements in how to supervise the sector, and some details we acknowledge so far include specific requirements on capital and liquidity, and also restraints on the leverage. And there are also curbs on the brokers' reuse of clients' assets to make other transactions, a lesson we learned from the collapse of the Lehman Brothers. And the Financial Stability Board Secretary General cautioned today that implementation is very important for G20 to achieve its target to make the global financial system more resilient and to prevent a repeat of the 2008 financial crisis, Mama.
Well, let's also talk about ratings agencies. Some countries are expected to bring this issue to world leaders, and many are saying that the ratings agencies have a negative impact on the world economy. Why is that?
Yeah, rating agencies also are concerned right now ahead of the summit in St. Petersburg, Italy, which risks further downgrade of sovereign rating, proposed to hand over the rating assessment duties to international organizations, so the power of rating agencies will be limited. And another proposal was to introduce more competition in the rating industry, and so there will be more competition between rating agencies, and there will be more fair and objective. However, it's still a controversial issue right now whether more players in the market is what needed right now. But what is absolutely needed is more transparency in industry, and this is an issue which is being heatedly debated at the ongoing summit, Mama.
Thank you so much, Guanxin, for a report from St. Petersburg. Well, global economic crisis seems in the air again, and this time centered on emerging markets. The aid charity Oxfam estimates that African countries lose 2% of their GDP from tax-dodging corporations who register in countries where taxes are lower. And Britain has also lost tax revenue, and UK Prime Minister David Cameron says he wants to persuade the G20 to help make corporations pay. Now, our correspondent Richard Bestic has this from London.
As host at the G8 Summit of industrial nations earlier in the year, Prime Minister Cameron
was able to press hard for international agreement on a level playing field for corporate taxes. The UK Premier might well look to the gargantuan profits secured by Britain's Vodafone earlier in the week when it sold its 45% share in America's Verizon telecoms company. Profits of $130 billion of no benefit to the British taxman because the company has taken its tax toll offshore. Cameron will be trying again at the G20, but observers are cautious.
But the idea that people can go and set up in tax havens and effectively pay very little, there's an element whereby that's becoming a self-defeating area, and I think Cameron is probably right to focus on that. I'm not altogether that happy sometimes about the sort of anti-business tone of some of it.
But tensions over Syria, embodied perhaps by Presidents Barack Obama and Vladimir Putin, are likely to obscure the issue of international tax. It's also suggested the parliamentary defeat on Syria for the UK government didn't do the British Prime Minister any favours.
They're coming to it considerably more bruised than they were to, the G8 Summit in Northern Ireland, where Cameron was very much on display. You know, this time they've had the Syria vote in the House of Commons, which did not go according to plan. The British economy is still sort of limping along. There's an element, I think, Britain is more kind of underpowered at this particular one than it has been before.
The UK has effectively been sidelined on the Syrian crisis by the parliamentary vote here. However, David Cameron could find that his international campaign against beggar thy neighbour tax policies bears some fruit in St. Petersburg, because London believes there is an apparent G20 consensus on the need to crack down on tax dodgers, even though, as city traders say, one country's tax dodger is another's corporate friend. Richard Bestick, CCTV, London.
And you're watching our special coverage on the ongoing G20 Summit. Let's now take a short break, but stay with us. Welcome back to our special coverage. As we mentioned many times in the program, the emerging economies are very important in this G20 summit. Now, leaders from the emerging Brics countries have held meetings on the sidelines of the summit. The members of the bloc of 5 large emerging economies are Brazil, Russia, India, China, and South Africa. They've discussed a joint foreign currency reserve pool of $100 billion to help countries facing currency shocks. And leaders also agreed on the structure of a proposed development bank with $50 billion in capital. Well, the Brics is an acronym for the 5 major emerging economies, as we mentioned, the 5 countries. And the idea was first conceived in 2001 by Goldman Sachs as part of an economic modeling exercise to forecast global economic trends over the next half-century. The grouping was originally known as BRIC before the inclusion of South Africa in 2010. South Africa was invited to attend the 3rd BRIC Summit in China on April 14, 2011. The BRICS members are all developing countries, but they are distinguished by their large, fast-growing economies and significant influence on regional and global affairs. All 5 nations are also members of the G20. As of 2013, the 5 BRICS countries comprise almost 3 billion people with combined nominal GDP of about $15 trillion.
So there are a lot of problems and also a lot of challenges for the BRIC countries. the talk of the G20 summit will also be focusing on how the emerging economy has been doing. What do you think are the most pressing issue for the emerging economies, including the BRIC countries?
Well, I think one pressing issue, especially in the grand scheme of the tapering of the quantitative easing by the U.S. Federal Reserve, is I think that the economic growth model. I think China is facing a similar issue, and so did many other emerging economies. I think many of the emerging economies have got used to the loose monetary system that has been the case in the past 5 years. And there has been a lot of excessive investment. There has been a lot of risky investments. There also has been a lot of ignorance or negligence in its social or economic problems reform. So I think this is about a time where many of the emerging economies would have to reevaluate its own situation and try to ask them the same question, well, if the money is not as easily available as it was 5 years ago.
But not every country is the same. For example, China may not feel the impact as the rest of the BRIC countries.
Exactly. I mean, for better or worse, I think China's constraint on the capital account flow is sort of protecting the country away from the rapid exit of foreign capitals. But at the very same time, I think China is already feeling the impact. I mean, Hong Kong, for example, has been feeling a lot of the exit of international capital, and also I think by the competition in the trade the arena, I think China is also feeling that a lot of its trading partners or trading competitors are going into this round of competitive devaluation voluntarily or not, and then China's products or services are all of a sudden seeming more expensive than before. So China would have to deepen its own round of reform as well.
Joseph, how do Europeans from advanced economies look at the impact of those tapering of easy money policies on those emerging economies?
Well, we see that emerging economies, as vibrant as they are, because they grow so fast, they are still vulnerable to internal and external shocks. And when you look at the Brics group from Europe, many people here wouldn't call it a bloc. They would call it a coalition because they see that there are enormous differences. The Brics country next to us here is Russia, and Russia is in no way comparable to China. Now, China has problems in its qualitative growth strategy, but Russia doesn't even have that problem. Russia is not growing qualitatively. Russia is relying on the export of natural resources. Russia is delaying the modernization of its industry. Russia is not seeking cooperation with international investors, with international corporations. And if you look at China, it's just the other way around. So the situation is very different, and there is no single remedy for this.
Well, Joseph mentioned one thing that is very important. It is almost the same for Brazil or India and South Africa. They are different in their economic structure. So do you think the establishment of a contingency reserve fund of $100 billion for those BRIC countries, does it make economic sense?
I think it certainly does. I think it probably can serve two different purposes. One is in the immediate term, I think it is going to alleviate the concerns or the struggle that India and Brazil are having. I mean, I think just by having a system in which I think the international investors or the investment communities seeing that it's not just a single country is that they're fighting against, it's a block of country or block of reserves. I think that it will drive away some of the problem. This is a self-fulfilling prophecy. And I think in the longer term, which is probably more important strategically, is, well, once you have this mechanism, you could have eventually a competitive monetary system that is possibly comparable or competitive with the current IMF. And just by having this possibility or alternative could give a lot of pressure or incentive for the IMF itself to reform. So this will put a lot of incentive for the global financial monetary system to progress further along.
So do you agree, Joseph, the establishment of a BRIC fund will probably expedite the reform of IMF?
Yes, I do. I think my Chinese colleague has a very good point there. I think very clearly this facility will help the BRICS countries to deal with themselves in a fast way and in a way which they will determine with short-term financial problems. And the midterm signal is, look, we're dealing with this ourselves. So far, the 100 billion will not suffice to really challenge the IMF and the potential that the IMF has. But the message is there. The signal is there.
Mm. And where do you think this kind of a mechanism will develop? Will it one day become larger and more efficient to replace IMF?
I think it depends on a lot of things. One thing is, well, how fast IMF will be able to reform itself. Let's say that IMF can successfully hear what the BRICS country or the emerging markets have to say, then maybe there's no incentive or there's no real urgency for the BRIC countries to take things into their own hands. Mm-hmm. On the other, I think just as things work out in this recent, whatever you want to call it, crisis in the emerging markets, I mean, eventually how cohesive will this bloc of BRICS countries and how much variation there will be, because there has been some notion about China is actually leading some other BRIC countries during this process. So I think what's going to happen to Chinese economy and what's going to happen to the rest of the BRIC countries will have a lot of influence on what eventually will work out of both. And
do you believe that China will take the helm of this institution, or there will be rotating?
I think just by the starting efforts and just by the current allocation of quota and the funding, I think China is de facto taking the leading role right now.
All right. Well, there is more angles from reporters on the ground. Mama will take over from here. Mama.
That's right. So yeah, we have RT correspondent Anissa Noe. She's joining us from St. Petersburg. Well, Anissa, it's been a busy day with world leaders meeting each other. And so what can you tell us about the latest developments at this hour?
Well, it's very clear that Syria is going to be taking over most of the agenda at this G20 summit, even though officially it's not even on it. Of course, the world's 20th richest nations were supposed to focus on reforming the financial sector. This first day of the summit has, at least we're anticipating and speculating that behind closed doors there's been a lot of talk of Syria. Of course, the bilateral meeting between President Putin and his Chinese counterpart. We do know that China stood behind Russia on supporting no military intervention in Syria. With that said, the BRICS countries did meet on the sidelines on this first day, and they will meet on Friday, tomorrow as well. Today, they basically came up with a plan to start a $100 billion foreign exchange fund to protect themselves, these emerging markets, from any fallout from the United States and from really the financial crisis of the richer countries. And so they're creating these defense mechanisms, and we're hearing on Friday the focus of the BRICS will be on trying to create, or at least beginning to create, a sort of answer to the IMF, an IMF alternative, a bank that would protect them against any future crisis.
Right, Anissa, while the economy in the U.S. and Europe are gaining momentum, what about the emerging markets? What can we expect from leaders of these countries to come up with some sort of measures to stabilize their economies?
Well, like I said, the emerging economies are really facing the fallout from the richer economies, more specifically the actions of the Federal Reserve. And so you have these bonds being sold off and lots of available dollars. And the emerging markets are feeling this pinch even more strongly than the richer countries. So they're going to try to come up with reactions, excuse me, reactions to that. And one of them is going to have that foreign exchange. Up to $1 billion was promised today. Of course, in the second day of the meeting, they're expecting to go more into details. And again, they know that the way the financial system is built now, the IMF at the center, is just not going to work, especially after the financial crisis of 2008, to which really the emerging economies are still feeling the bite from that, even more so in many ways when it comes to their growth than the countries that really, at least the BRICS countries, feel were responsible for that crisis.
Right. Thank you, Anissa, for your report from St. Petersburg. Appreciate it. Also, Anissa said a lot of things are now right on the table: tax avoidance, effective regulation, and also monetary policies.
Yes, and what actually brought us here 5 years ago, it is the financial meltdown that originated in the U.S. So, Joseph, 5 years after, do you think the world economy is on an uptake trend? Where is it going?
Not really, because the initial financial crisis has exposed the sovereign debt situation of the countries and has led us, in effect, into a second crisis and has raised so many suspicions around the world about the feasibility of debt management on the one hand, and at the same time the continuing weakness and instability that we see in the banking sector. And if I look at my own region here in Europe, this is one of the issues that is still plaguing the economy, that even though the core interest rate, the reference rate of the European Central Bank is at 0.5%, lending in the Eurozone is still not where it should be, and there still are question marks about the viability of a number of regional banks in the south and southwest of Europe.
And here in Asia, a Chinese economy, Indian economy has been slowing down. Should it be concerns for us?
I think, there are some concerns about whether the slowing down of the emerging market will have some impact on the global economy. But then I think if one looks at the longer term objective or the goal of the economic growth, I think the slowing down, at least in China's specific situation, is sort of paving the way for the longer term sustainable growth, because only by slowing down can China successfully reform its economic growth model, and only when China can succeed in that direction will China's economy really be able to integrate into the global economy.
All right. Thank you very much, Joseph Jennings and also Professor Zhu Ning, for your insight on this.
Well, world leaders are now in the Russian city of St. Petersburg, where they are discussing financial and economic issues and also some political issues on the agenda.
Indeed. Well, their attention will be focusing on a lot of things: economic growth, financial stability, quality job creation, and tackling unemployment, searching for the new sources of growth and investment financing, as well as strengthening multilateral trade and international development assistance.
Right, and we're going to bring you more special coverage of this event at the same time tomorrow. And now we'd like to thank our guests joining us from around the world.
And we'll be thanking Joseph Jennings and also Professor Zhu Ning and also Maricruz Magwatz from the U.S. And with that, we come to the end of this program. I'm Zoe in Beijing.
And I'm Wang Mengmeng. Thanks for watching. Goodbye.